Good morning and welcome to the CT Private Equity Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to Fund Manager Hamish. Mair, good morning to you.
Good morning, everybody, and thank you for joining this webinar on CT Private Equity Trust. We're going to take you through the third quarter results and cover the main highlights of that. The other thing that you will have noticed that came out a couple of days after the results is that I will be retiring in 6 months' time, and from the beginning of June, the new manager of the company will be Andrew Carnwath. Andrew's joining me on the webinar today, and I think most of you will have heard from Andrew already because he has taken part in these before, and he's going to be doing a good section of the presentation today. So Andrew and I have worked together in total for about 12 years, very closely. And Andrew had a stint at SEP, the leading growth equity manager, where he was a principal. And he's also taking over as head of the private equity business here at Columbia Threadneedle. And I'm entirely confident that the company will be in good hands going forward. And although you will hear from me a couple more times before I retire, you're going to be hearing a lot more from Andrew in the future. And so congratulations to Andrew on that step up. And we'll now run through the key points of the interims. We just got this investment risk slide, which I am informed is extremely important for you all to observe and digest. The company has done well over its 26 years of its history. I've been involved all the way through. You can see some of these awards at different times. Recently, we were one of the top best performing trusts over 10 years, according to the Association of Investment Companies, and we're also a next generation dividend hero, which means that our dividend has increased every year for over 10 years. I think we're on about 13 years so far. And we've also had some other awards at different times. So just looking at the executive summary of the third quarter numbers, so that's the quarter to the end of September. The NAV was up 4.1% and NAV total return, which means that for the year to date, we're up 1.5%. And that doesn't sound massively exciting, but it's a perfectly respectable situation to be at this stage in the year. We still have the final quarter to come. And that's important because the final quarter essentially has almost 2 quarters worth of movements in it, because the NAV at the end of September is largely composed of 30th of June valuations, just because of the timing of when we receive the underlying valuations. And so basically, by the time we have the full year numbers for December, which will be in late March, we should have the benefit of most, if not all, the December numbers and all the September ones. So a significant movement in the final quarter is quite normal, so that's something to watch out for. A couple of the other important highlights are that realizations in the third quarter were 30.8 million, so that was about doubling the realizations from the previous quarter, and it brings the realizations in the year to date up to 57.9 million, and we still have a quarter to go. So after a kind of quiet start in terms of realization, things are definitely picking up. The whole of last year, we had 108.6 million of realizations. We probably won't achieve that level this year, but it should be quite a healthy number nonetheless. Dividend at 7.01 pence was paid, will be paid at the end of January, and there was one that was paid at the end of October. So the dividend hasn't changed because the NAV hasn't moved up sufficiently, but once the NAV starts to move up again, the dividend will move up. It's a sort of upwards only dividend policy, as those of you who follow the company will remember. It gives us a pretty good yield. The price is up a bit since the period end, but still a very handsome yield. And our co-investment element of the portfolio is just below 40%. Long-term aim is to bring that up towards 50%. That's quite difficult to achieve because we keep selling things, which is a good thing, but it's on a kind of rising trend. I'm now going to hand over to Andrew, who's going to talk you through a few of the exits that we've had in the relatively recent past.
Brilliant. Thanks, Hamish. So in terms of recent exits, one of our previous top 10 holdings was ATEC. This was a co-investment we did alongside Kester Capital, and it's a niche insurer. So they provide insurance for niche areas like boats and caravans. Really nice business that Kester managed to grow very rapidly, expanding both the product offering, but also establishing their own managing general agent. Very much a data-driven business that, as you can see on the slide, grew very rapidly, and the business was sold to Perwin, a family office and private equity group, for over 4 times cost in September. The exact return is not disclosable. Another recent exit and another previous top 10 holding was Amethyst Radiotherapy. Again, this was a co-investment, this time alongside the Rahatton Group, which is a Central Eastern European specialist. And they very successfully took Amethyst from being headquartered in Romania to making it more of a Western European business, now headquartered in where is it headquartered? In the Netherlands. It's a market leader in provision of radiotherapy across Europe, and despite the disruptions of COVID, continued treating patients with life-saving treatments and grew very well through a combination of establishing new greenfield sites and through buying up older sites and improving the equipment, which directly leads to better patient outcomes. So it went from 9 centres treating 11,000 patients a year at the time of our investment to 19 centres treating 20,000 patients a year by the time we exited. And that company was sold to Fremen Capital, a private equity group, returning over 8 billion. We then had a number of companies sold into a continuation fund. So these were 4 companies or investments managed by Inflection. They had all outperformed their original investment case, but Inflection saw huge potential in all of them going forward, and so raised the largest multi-asset continuation fund in Europe to date, to buy these companies, providing a good return to existing investors and hopefully continuing to grow the business. So we received 6.4 million of proceeds back from that, and we keep exposure to those businesses through our holding in Inflection Strategic Partners. And I think finally, in terms of the recent exits, we sold the remaining stake in Dotmatics. So this is a software business for R&D scientists, helping scientists to collaborate both within laboratories, but also between laboratories to drive the efficiency of R&D and the development of novel treatments and vaccines at pace and at a lower cost. We made the co-investment alongside SEP, my old firm, and we sold most of the business back in April 2021, and then we retained a 12% stake, and that was recently bought by Siemens. And so that takes our total return to 8.3 times cost and nearly 80% IRR. So a fantastic result.
Okay, thanks, Andrew. Just looking at the longer term progression of the NAV and dividends, you can see that on the chart here. The dark blue section is the cumulative dividend, so you can see a good decent upward trend there. I've already mentioned the next generation dividend hero aspect, but it's worth stressing. If you're an investor in these shares, you can get good capital gain and a good yield. This is the chart of the NAV total return, share price total return. Over the long term, there's not much difference in these, but in the recent past, there has been a bit of a gap. So the NAV total return is ahead of the share price total return. I always say that this gap is a bit of an opportunity. We have greatly outperformed the stock exchange over the time period. I mean, the gains that one would have made had you reinvested your dividend all the way through the life of the company are about 4 times the gains you would have made if you just bought the stock market index. And that underlines the long-term case for private equity and staying involved in it. You compound these premium returns year after year, which means that the asset class tends to perform just about every other readily investable asset class. This is just another way of looking at performance over the short and medium term. We have had a couple of sort of quiet years, if you like, in terms of NAV progression. At the beginning of this year, we were expecting things to improve noticeably. There has been a bit of a hiatus, which we can talk about, but the last quarter is showing some signs of improvement, and the tenor in the market generally is better. So we're expecting a better future than the very recent past. In terms of the outstanding undrawn commitments, this is just something to monitor. These are at very ordinary levels, fairly low actually, 168 million. We have to have these commitments in order to make sure that the company remains fully invested. These commitments are to a very large number of individual funds, so there's no risk of us suddenly being drawn for all of them at once. I mean, that just won't happen. And the level in relation to the net asset value is, it's very close to the 5-year average. Actually, it's just below that, so that is nothing to be concerned about. Similarly, just looking at the debt levels, we had net debt of 91 million at the quarter end, which is down a bit, and it's on a reducing trend here. We have got plenty of headroom in our borrowing facilities. We do actually believe in having gearing. The portfolio is very well diversified. It is a good portfolio against which to lend, and so we always have banks that are prepared to lend to us. And the returns that we expect to make from investing the portfolio are far in excess of the cost of borrowing, even with the cost of borrowing having gone up a bit in the last year or two. And it gives us plenty of funds available to take advantage of opportunities if we have any sort of mismatch between realizations and drawdowns. So I'm just going to hand over to Andrew, who's going to talk you through some of the things that have been going on inside the portfolio.
Yeah. So this slide just shows the new investments made year to date. We're seeing really strong deal flow, both in funds and co-investments, and just selectively making new investments to drive the business forward for the future. So Friendly was a co-investment we made alongside Procuritas. a group we know very well. They had created Friendly to consolidate the Finnish market for IT services. The business provides IT services to SMEs within Finland. It was initially created by putting 10 companies together. They then continued to consolidate the fragmented market, acquiring a further 8 companies. The investment had taken a little bit longer than expected, and we were given the opportunity to come in at what we believe is quite an inflection point. A lot of the hard work had been done. The 18 companies were integrated, and we can see the growth now coming through. So this hopefully should be quite a short hold for us. We then invested in Keka Real Partners 2. So this is a emerging manager in Spain that is targeting what we believe is the very attractive lower mid-market in Spain. It's not very well penetrated by private equity, but there are some great businesses there available. The firm was founded in 2018 by some very experienced private equity executives that we knew well through their previous roles. And they teamed up with some very well-known founders and operators, entrepreneurs within Spain to form Keka. Fund 1 has performed incredibly well, and we came into Fund 2 at the very end of their fundraising. They held it open for us, and at that point we had great visibility on the first 3 deals into the fund. So early days, but off to a good start. We also made an investment, 5 million commitment into HG Mercury 5. So as you know, HG, leading software and services investor. This is their what they call lower mid-market. I guess we would consider it more sort of mid-market fund. So investing in the sort of mid-sized, small to mid-sized businesses. Excellent track record, and we think the smaller fund is probably the most attractive one and fits us much the best. And then Kester, who you heard about earlier, another emerging manager. We invested with them a number of co-investments. So we've done 3 co-investments to date. 2 of those very successfully exited in terms of ATEC, which you heard about earlier, but also Jolly's, the pet chain. They've been performing very, very well, and we made a 5 million commitment to their new fund, which was heavily oversubscribed. And that's investing in the UK life science and technology businesses in the low mid-market. And finally, a co-investment in Vanda alongside FPE Capital, one of our high-performing managers. Again, this is a business that the manager had been in for a while, and so got to know well. And we have come in to help them to do a transformational acquisition, which, if it's successful, and we hope that will complete early next year, will sort of doubles the size of the business, but also take it into new areas. So Vanda is a data business, and it provides data and research to the financial services customers. Its specialism is in flow and positioning data within equities, commodities, and foreign exchange. And it provides that data to hedge funds, investment banks, and asset managers. That, as many of you will know, is a emerging market. It's relatively small at the moment, but growing very rapidly. It's predicted to grow at 13% over the next few years. And we believe Vanda has carved out a real leadership position in that area. So quite an exciting co-investment And again, likely to be a sort of shorter hold as we're going in partway through the investment. On this slide, you can just see some of the significant realizations over the year. I'm not going to talk to all of them, but you can see strong money multiples and strong IRRs across them, but also a whole range of businesses in there. And that just continues on to this slide. In terms of drawdowns, again, a real range of businesses, both some co-investments in terms of Vanda and otherwise through our funds.
So just quickly, looking at the distribution and drawdowns record. I mean, basically, when you tend to have a lot of one, you tend to have quite a bit of the other. And the converse is also true. There is a connection. We can clearly control the amount of co-investments we make directly. In the most recent quarter, there was actually a surplus of distributions over drawdowns and co-investments, which is fair enough. It allowed us to de-gear slightly. But this is really just here for the record. I'm just going to hand back to Andrew to talk about the top 10 holdings and just sort of highlight things to watch out for.
Yeah, so top 10 on this slide, which you can see accounts for 24% of net asset value. So well diversified by sector, geography, and lead manager, and with no single company dependence. So looking at the top business, Weird Fish. So this is the clothing brand that's trading really strongly under the new CEO. And actually, just after the quarter end, we have completed a recapitalization of the business. So that has returned 7.5 million this year. And we continue to hold a large stake, which should do very well going forward. There might be some opportunity for some more near-term liquidity. In terms of new arrivals into the top 10, you can see Cardo at number 2. So this is a fantastic business headquartered in Wales. It does maintenance for social housing, and it has been growing incredibly rapidly. We just had the CEO of the business talking at our Capital Markets Day recently, and he's grown that business very well through a combination of organic growth and multiple acquisitions, building out their coverage across the UK. And again, that is one where there's a possibility of a good amount of liquidity in the near future. Another top 10 company at number 9 is Cyberhawk. So this is the pioneer of using drones to inspect critical energy infrastructure. They also have proprietary software which enables asset owners to see the status of all their assets, where they are in the world, and then sort of really drill in and see inspection photography, what is wrong with assets, what needs to be replaced, and indeed to instruct that all within the software. Been growing very rapidly, particularly in the US, where it's got some large contracts with large utility companies to inspect their assets, and in particular, transmission assets, transmission poles and wires in high-risk areas, and therefore preventing forest fires.
Great, Andrew. Thanks for that. One thing, if we just go back slightly, just to stress is, if you look at the size of these top 10 holdings, between 1.7 and 3.3% of net assets. So these are significant positions. So if they if they go really well, they're big enough that they can move the needle nicely. They're also small enough that if something goes wrong, it's not going to completely upset the apple cart. And that's why we maintain a really well diversified portfolio. And obviously you can see the vast range of different types of companies, different managers, different geographies that are represented there. So just looking at the overall portfolio, just this point about diversification again. By geography, we have about 40% in the UK. Now, we've always had about that level. Importantly, this does mark us out against our peers. Most of them have a tiny proportion in the UK market. We actually like the UK market, not just because we live here, but because it's the largest and deepest, longest established private equity market in Europe, and it has excellent deal flow. Most of the rest of the money is invested in continental Europe, and we're involved in all the main private equity markets there. And there are opportunities in these markets which you can't find in the UK. So it's all complementary. And we also have a significant, but relatively small amount in the USA. We always have had that. It's 14% at the moment. It's about the same as it has been. We've got some excellent long-term contacts there, and where those continue to work for us, we maintain them by making fresh commitments. In terms of the age of the portfolio, the key thing here is that we always have an element of the portfolio that is maturing, and each underlying deal is normally organized around a sort of 4-year hold. Now, often it is longer than that, but that is the expectation going into the deal. So after about 3 years, if things have been going according to plan, the lead managers will be planning an exit, appointing advisors, etc. So we track the proportion of the portfolio that is over 3 years old and also over 4 years old. And it's about 60%, which is over 3 years old. And so we always will have a decent element of the portfolio that will be approaching maturity, and that will lead straight into realizations. In terms of the valuation, it's not particularly stretched. We have if you look at our co-investments, which are actually representative of the overall portfolio, we're on an EV to EBITDA of 10.3 times. And in terms of the level of indebtedness of the underlying companies, they aren't very heavily indebted. It's debt to EBITDA is 2.3 times. So basically, a quarter or a fifth of the balance sheet is debt. It is a key component of driving value, but it's not a particularly risky and over-levered position. So looking at the diversification by sector, this hasn't changed significantly in the recent past. The two big sectors are healthcare and information technology. And information technology is software and services. A lot of it is software. And healthcare is also quite a wide range. It's healthcare providers, as well as technology equipment, and not very much in sort of biotech and pharmaceuticals. But if you take these two sectors together, it's almost half the portfolio. And we don't make any apology for that. We see long-term secular growth, lots of innovation there. And because of that, it is an attractive sector to private equity internationally. So there are lots of different subsectors within these two big portfolios. So we've maintained diversification whilst benefiting from these strong trends. We've also got plenty in the other large sectors: industrials, consumer, financials, business services, all these sort of things. So we believe very strongly that we should maintain a well-diversified portfolio. You'll have heard it from me before, that the only way I know of reducing the innately high risk of private equity down to moderate levels is by running a well-diversified portfolio. And that's exactly what we're doing. So just to conclude, I mean, we have had a sort of a quieter first half of the year. At the beginning of the year, we thought that a lot of the ingredients for a decent recovery in private equity were in place, and we'd seen a pickup of realizations last year. But there was quite a lot of uncertainty induced by the sort of tariff wars, if you like. Now, I can't put the entire blame on President Trump, but he does merit quite a large component of it. And so that induced uncertainty into the market. There was a hesitation on doing deals. There was a rebasing of deals. There was stretching out the timetable, things shifting to the right or being called off. Now, that has, we think, worked its way through the system, or largely worked its way through the system. And we saw in the third quarter quite a significant uptick in realizations, which we think is a sign that confidence is improving. Also from our contacts with companies and investment partners in recent weeks, we do see an improvement in the confidence levels, and this whole tenor of the market has improved. So we now think the ingredients for recovery are in place, and we would be quite optimistic going into 2026. We have achieved a whole lot of exits this year. I mean, the average return for a company that's exited has been 2.7 times cost. And importantly, they have been sold at a significant premium to carrying value, 20% premium. Now, that is a bit lower than the long-term average, which is 3.5 times cost and 47% uplift. That reflects quite a buoyant period, but it's still a very significant premium. And the reason we talk about realizations a lot of the time is that realizations do tend to be well above the valuation, and so there is a correlation between strong realizations and growth in NAV. It's not the only factor, but it is a significant one. It's one to track. As you can gather from the activity in the portfolio, we've seen excellent deal flow both for funds and co-investments, and we continue to be active on both sides there, laying the foundations for future growth. We've got a good balance sheet. We've got plenty of excess borrowing facilities, and the portfolio, as I've already mentioned, is extremely well diversified with some high growth dynamic companies. And the underlying fundamentals are good. I mean, the revenue and EBITDA growth in the 12 months to June, which is the latest period for which we have reliable numbers, is 23% in both cases, revenue and EBITDA growing at 23%. Now, that isn't the same thing as earnings per share growth, but it is a very positive indicator, and that will come through in improvements in valuation and in amounts achieved on exit in due course. And because of that, we remain confident the company will continue to grow value for shareholders over the short and longer term. So that's the end of the actual formal bit of the presentation. So we'll maybe just turn to the questions now.
Sure. Good morning, everyone. My name is Peter Brown. I'm part of the investment trust team at Carnwath Threadneedle. Thank you for your questions. Please continue to submit them in the right-hand side of your screen if you wish. There's been many statements wishing you a very happy retirement, Hamish, but I know you're far too humble to broach that subject. So we'll move swiftly on to dividend. So we've got a couple of questions I'll merge together. What is the outlook for dividend growth combined with can the current level of dividends be continued over the next 5 to 10 years? So I think it might be worth just specifying the policy for this trust.
Yeah, so dividend growth will grow in tandem with the growth in the NAV. So the dividend is paid out quarterly, and it's 1% of the average of the previous 4 quarters NAV. And if that number comes up to be a level below the last dividend, we maintain the previous dividend, which is what we've done in the last year or so. But as soon as the calculation produces a number that's above 7.01 pence, the dividend will increase, and then it will just continue increasing in tandem with NAV. It's set at the level of 4, for a year, it's set at level of 4% of NAV. That was a deliberate level chosen to be a worthwhile amount to be returning to shareholders every year, but not an excessive amount. So that is a specific level that we've been able to maintain for every year since 2012. And we expect to continue to be able to do that. Now, we can do that because we're paying out not just of revenue, but out of realized capital profits. just to remind you, this was the first investment trust that took advantage in the change of the law to allow the payment of dividends from realized capital profits as well as from revenue. And lots of others do that now, but we were the first to do it. And we think that allows our shareholders who are primarily interested in capital gain also to get a decent income. And they can keep that if they like, or they can reinvest it back into the shares, which a lot of them do. And so this is a kind of have your cake and eat it type of situation, I would say. So we expect the dividend to grow in tandem with NAV growth into the future, and we run the company so that the dividend is safe.
Thank you. And alongside dividend is important sort of share price for shareholders. I'm going to merge three questions here. The uplift in the share price in the end of last week was most welcome, and the narrowing of the discount too. Do you envisage this continuing? I'll merge that with another question along similar lines. What do you believe is behind the recent increase in share price? Also, there is quite a wide trading range in most days of a few percent. What is the driver of this? And finally, if I could just add a third, which is basically in terms of wider discount, do you think enough people are aware of the attractiveness of CTPE given the high dividend along with the potential for capital growth, especially those who might be drawing down on their SIP?
Yeah, well, I very much hope the discount will reduce. I mean, there's no simple solution to that other than for us to get the message out and to make more buyers than sellers. So explaining what's going on in the portfolio and the momentum, etc., is a big part of that. I mean, the share price had been quite sort of range bound for a while. We've broken out above £5, which I think is a good thing. I mean, currently today, I think we're on about 26% discount to NAV, which is still too wide. The various factors involved here. I mean, most of our peers are actually on, similar or wider discounts. So the whole sector has this as an issue. I think it's partly to do with the general attitude of the market towards risk. When the market is a bit more risk on, the discounts on these trusts narrow. When they're risk off, they widen out, almost irrespective of what the fundamentals of the companies are telling you. I think we have seen an improvement in the sort of risk on aspect here. And also there's I think a recognition by those who follow these shares that there is, significant value here. It is not a sort of sustainable situation, if you like, to have a very wide discount when the asset value is already itself innately conservative, as we've just discussed. You're achieving realizations at a significant premium to carrying value. So you've essentially got a double discount here. We've already talked about the dividend, so you have a double discount, plus you also have a very handsome yield. So there's lots to go for, but it's our job to get those attractions out there into the market. There's a question about the volatility of the share price. Well, actually, if you look over the long term, it's not that volatile. The liquidity is it's better than most of its peers. Now, that doesn't mean it's massively liquid, but from the point of view of individual investors, you should be able to fill your position reasonably, not necessarily immediately, but reasonably efficiently. The bid offer spread does fluctuate a bit, but that is also probably not untypical of the companies in our sector. At least you should be able to deal, though. Is that all the main points, Peter?
Yes, I do. I think you've covered most of it. And I would state that the NAV came out, I think, last week, which was obviously quite positive, and that probably boosted the share price a little bit as well.
I mean, it might have been because my retirement was being announced, and
no one has suggested anything of the sort. I guess I'm sure.
I think probably a big driver of the discount, hopefully, will be if the exit activity picks up. As Hamish mentioned earlier, we'd expect to see those premiums on exit driving NAV growth, and I think that should certainly help the discount come in. I think another one is potentially interest rates coming down would be helpful as well.
Yeah, very good points. Right, moving slightly more technically now. One question, I'll merge two questions together again. I think both the weighted average EV/EBITDA and net debt to EBITDA have been on a downward trend. Does this reflect the growth in EBITDA or anything else? And I'll merge it with, what do you think the outlook for organic revenue and EBITDA growth for the portfolio is next year?
Yeah, the valuation has gone down slightly. I mean, it doesn't sort of move by large amounts, quarter by quarter, but 10 times is actually not bad. I mean, again, if you look at our peer group, it's actually significantly lower than most of them. That's because we have a lower mid-market focus. And I think you will have found, and it's difficult to get reliable statistics on this, but I think during 2025, you've probably seen a bit of a reduction in the multiple on private equity deals. I mean, not a huge reduction, but a bit of a reduction. So I'm not sure it's necessarily going to go down any further from here, particularly when we've had a slightly better sort of tenor in the market. In terms of the debt to EBITDA, now bear in mind that almost all the companies in our portfolio are sort of management buyouts. They all finance at least part of their growth with debt. There's always going to be a significant level of gearing in there. Partly it reflects the stage in the life of the holding. So typically, if there's a new holding going in, and this is an average I'm talking about, you typically would have half the capital structure would be debt and half would be equity. So if it was if you're buying at say 8 times or 9 times, then you'd have debt to EBITDA would be 4 or 4.5 times. So at under 3, you've had a bit of de-gearing because on average these holdings have been in the portfolio for a few years. So at the current level, the gearing is quite low actually. Now the good thing about that is that obviously interest rates have gone up a bit, so the cost of borrowing is higher. So you do not want to have a excessively geared underlying portfolio when debt is expensive. But we don't. I mean, we're actually quite low. I mean, it's been normal for the debt to EBITDA to be around about 3 times, and so we're well below that just now.
Yeah,
does that cover those two, Peter?
Yeah, exactly. Thank you. Next one regarding vintage. Again, I'm going to merge two questions. What are the pre-2014 investments? Are they discounted? And could you comment on the 10% of value held in the 2017 vintage? This seems a little high as this vintage is coming to the end of its holding period, assuming the 10-year fund terms.
Yeah, we'd have to sort of break that down. Now, one thing that you should not, one conclusion you should not draw is that if you have a significant value in a old vintage, that this is somehow, odd, because there are companies that have been in the portfolio for quite a long time and where there's been, 1, 2, or even 3 variations on the original investment thesis, but which still have a decent future and have some decent value. Now, the things that are old that are in the portfolio that have not succeeded, there will be very little or perhaps no value ascribed to them. So where you have these apparently older positions where there is significant value, that is because there still is real equity value there, and there quite often is substantial upside. So I mean, just without breaking down the portfolio exactly, I mean something like OHI, which is in the top 10, which is a helicopter company which is based in Brazil and services the sort of offshore oil industry in Brazil. That has been in the portfolio for quite a long time. I can't remember exactly how long, but it's well over a decade. And yet that business it's had its ups and downs, but it's actually doing quite well at the moment. And so there is significant value there. And the lead manager, Sterling Square, are sort of desperate to sell it. struggling to sell it basically because it's connected to the oil industry and it's in South America, which are generally not, too attractive features at the moment. But fundamentally, it is a sound business and it's got good profitability. So at some point that will be sold. So that's why you can get these they look like outliers in terms of the portfolio, but it's quite normal for there to be a few like that. The other thing to bear in mind is that when things are written down, the valuation methodology is innately conservative. It doesn't mean that value is gone forever. I mean, provided the company is still viable and hasn't, the equity has not been wiped out completely, there is a chance of recovery, and many times they do recover because the private equity lead in each of these deals is very much incentivized to get back as much as you possibly can. Even if they're not going to make a profit, getting more than zero makes a huge difference to their overall returns. So they are very much aligned with us in terms of achieving value wherever value can be found.
Thanks. Question is, can you please provide some light on the seemingly lower levels of co-investments in recent years?
In terms of the percentage, well, I mean, I think I mentioned this at the beginning. It's fractionally lower than it has been recently. I mean, we've been around about 40% for a while. It's 39, I think, in this valuation, and that is really because we've basically we've had quite a few exits, and in order to build the portfolio up, the co-investment portfolio up to 50%, we have to keep putting new investments in there and try and put them in at a faster rate, if you like, than they actually are being sold. Now, when they're sold, that is a good thing because they're generally sold at a significant premium. So we're not complaining about realizations, but we are on a rising trend towards 50% now. We're unlikely to go above 50%. We think that's quite an optimal mix between direct investments and fund positions. But it should be on an upward trend. I mean, we have done, I think, since 2003, we've done about 120 co-investments. That's across the whole business, but most of them have gone into this investment trust. So, we get a lot of deal flow. We see probably about 100 opportunities a year, of which we probably do, less than 10%. And the deal flow is excellent. I mean, we're always looking at things. I mean, there is a practical limit to how many can be executed in a year because they are labor intensive. But you should expect that co-investment level to creep up from here.
And on a similar theme, then, at what stage of the business do you look at, i.e., Series A or earlier, if the right profile? And what is your term, hold, or follow-on appetite for those?
Yeah, well, Series A is a kind of venture capital term for early stage businesses which are largely funded by their equity. The vast majority of what we do here are management buyouts. So we are basically investing into businesses that are profitable, and they are sufficiently profitable that they can carry a significant amount of debt. So we don't really use the terminology Series A. A lot of these companies, however, are ones which have not had private equity before. So the private equity firm is often coming in as the first private equity investor. That's not always the case, but a lot of them are. And that means that there is a lot to do for the private equity house, but there is also, to use that terrible expression, there is also quite a lot of low-hanging fruit that can be sort of harvested by the first private equity house involved. So, yeah, we have a little bit of growth equity, but even that would not be what you would describe as Series A. That would be at best late stage venture. We are quite skeptical about the benefits of venture capital. I mean, you hear a lot about it in the press, and you always hear about the guys in San Francisco and Palo Alto, etc. But you tend only to hear about the successes. You don't hear about all the ones that fizzle out quite badly. In private equity management buyouts, lower mid market in Europe, investing with emerging managers, we have found that to be a very attractive tier of the market to invest in. It's where all our returns have come from. Interestingly, it's an area of the market that some of the big private equity houses are now beginning to, cast their eyes over again, which is a good thing from our point of view, because they will hopefully buy businesses from our portfolio, and hopefully they'll overpay, and then we'll get nice premiums.
Lovely. There's a quote here, US private equity exit deals set for second year of recovery, pitch book finds. Are you seeing a similar thing in your holdings? Will 2026 be an even better year?
Andrew, do you want to take this one?
Yeah, sure. So I think the recovery in the US has certainly been ahead of Europe, but Europe is definitely trending that way. In terms of how 2026 will pan out, I'd say we're cautiously optimistic, but that is subject to any kind of geopolitical shocks. But yeah, I think the ingredients for a recovery are certainly there.
Brilliant. And we're trying to get through a couple of quick more before we end our time. Very briefly, how much of the movement in NAV this year has been currency related? I mean, being 40% in UK, I would say very minimal, but do you have those numbers to hand?
Yeah, it's basically neutral. It was fractionally negative in the first half, and it's been slightly positive in the third quarter. So I think there might be a very, very small positive in the first 9 months.
Lovely, thank you. There's a couple of questions on the Capital Markets Day. Was it recorded and available online? I can answer that. It's in production for some editing, and hopefully there'll be some snippets, if not the whole thing, available for people to watch on the website. There is a question here. Congratulations to Andrew on his promotion. Hamish mentioned that Andrew will be heading up the private equity overall at CT. How big a part of CT's overall private equity AUM is CTPE?
It's about a third. It's about a third of it. So, I mean, we've got, the gross portfolio is about 600 million sterling in the trust, and that's about a third of our overall AUM. We've got several limited partnership funds, and we also run a similar sized portfolio for the F&C Investment Trust. But this is our flagship. This is our shop window. This is where, the vast majority of our ideas go, and obviously we've got a long-term track record that we're very focused on maintaining.
Absolutely.
As we said, I haven't answered the question on the organic revenue and EBITDA prospects.
Yeah, I was going to go back to that. I think a little hand slap from me. I don't think Hamish answered the question about organic revenue and EBITDA prospects for next year. And can you disentangle the organic revenue and EBITDA growth from the 23% growth you mentioned?
Yeah, Andrew, why don't you take this one?
Yeah, so overall revenue and EBITDA growth for the year to June were 23%. I think what's interesting there is that we've seen those stabilize. Looking back a bit, we saw revenue growth, but that not flowing through to EBITDA with inflation coming through. Then we saw EBITDA growing faster. They're now in parallel. That growth does include M&A and add-on acquisitions. I don't have the exact figures for how much is M&A. My guess would be about a third of that, probably a third to maybe a bit more. In terms of the prospects for next year, I think they're good. We've seen growth picking up. Most of these companies are not dependent upon overall GDP growth. They're positioned in growing niches, and they're often niche market leaders. And so I think position's quite good.
Lovely, thank you. And we'll leave it there. We will come to any questions that we didn't get to in this presentation. You'll see all the answers on the Investor Meet Company website. But if I can just pass to you two chaps to give a final summary of the quarter and the outlook.
Yeah, thanks very much. Thanks everybody for listening. I hope we covered most of the points of interest. So as you can tell, we are optimistic. We are 3 quarters of the way through the year. We've got the final quarter to come. and we're seeing some good signs in the market. So we're hopeful of a decent sort of finish to the year. This is a long-term investment activity. You can see the long-term returns that we've delivered. That's a result of a process that has been ingrained for many years. Andrew is fully bought into that because he's been part of it for many years. So we expect it to continue well from here. Obviously, a lot of this isn't fully reflected in the share price, and we would encourage people to have another look at it. I always say that getting into private equity and staying in it, adding to it, gradually over time, is the sensible thing to do. It's very difficult to sort of market time things precisely, but at the moment, when you've got a really attractive dividend yield, still a reasonably wide discount, there's a lot to go for, because as NAV accelerates and hopefully the discount narrows, and bearing in mind that the underlying portfolio has got a reasonable amount of gearing, there's scope to do extremely well. So thank you everybody for listening and for your support. And in due course, when Andrew takes over, hopefully you'll give him as much support as you have given me over all these years. Thank you.
Thank you very much, everyone.
Perfect. That's great, Hamish. Andrew, thank you very much indeed for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of CT Private Equity Trust PLC, we would like to thank you for attending today's presentation, and good morning to you all.